Welcome back. Early Thursday morning this week, Toronto Dominion Bank will release its quarterly results for its fiscal second quarter. That will kick off bank earnings season once again here in Canada. Let's get a preview of what to expect. Joining us now is John Aiken, Director of Research for Canada and Senior Analyst at Jefferies. He's covered the banks for a long time. John, thanks a lot for joining us. Over the past year, from the end of April 2024 to the end of April 2025, the rate of unemployment in Canada has ticked up from about 6.2% to 6.8% at the most recent reading. Do you expect that run up in the rate of unemployment to be reflected in credit quality at the banks?
Yes, Paul, we do. We are expecting to see basically a lot of provisions being taken against loans in the quarter, but a lot of this is actually going to be against performing loans that haven't gone bad yet. But basically, because the outlook has deteriorated significantly from where we were 3 months ago, we do think the banks are going to put some of the provisions, the allowances in their back pocket. Specifically, though, when we're looking at unemployment and what that may mean for impaired loans or non-performing loans, we are expecting to see a tick up in non-performing loans, but really not falling off the cliff yet. The unemployment numbers do illustrate some weakness in the economy, but actually what was really driving the uptick in terms of the unemployment level is actually more labor force participation, not necessarily job losses. Again, not necessarily a great thing. However, it's not looking like the round of layoffs that we've seen recently are going to be embedded in the bank's numbers for the second quarter. That's likely going to be in the third quarter. So we continue to see some pressure on provisions and on credit, not just this quarter, but carrying through the rest of the year.
What kind of trends would you see in commercial or business lending, John?
Right now, actually, surprisingly, in the fourth quarter and the first quarter for the Canadian banks, commercial lending was actually reasonably strong within context. Now, the fact of the matter is that there's a whole host of uncertainty with the trade wars, tariffs, everything else that's going on. Anecdotally, we have seen businesses pull back in terms of their spending, and we do think that we're going to see commercial lending growth slow, but still stay positive. We're not expecting loan balances to decline on the commercial side, but move to probably low to mid-single digits versus the higher upper single digits that we've seen in the previous quarters.
How much impact do you expect to see, John, from U.S. tariffs, Canadian retaliatory tariffs, or even perceptions of what those tariffs could do to the Canadian economy?
Yeah, Paul, I think you're striking really at the heart of the matter. When we look at the bank's quarter end being April 30th, we're not really expecting to see too much of the full impact of tariffs being baked in the numbers. But I think what's going to be more important than actually what the banks report is management's commentary and their confidence or lack thereof in terms of what the outlook is going to be. Now, we do believe that we're going to hear reasonably positive commentary and context is very difficult for a bank executive to say, no, our outlook is absolutely awful. But it's going to be, everyone's looking for what that leading edge is going to be. And the banks definitely have a bit of an advantage in terms of all the data they're getting from the customers. And basically, what the bank executives spell out in terms of outlook is going to be much more telling in terms of the valuation impact of this quarter than necessarily what the actual earnings results are.
The banks have rallied, the share prices have rallied in a big way, along with the broader market. One big reason the TSX Composite is in new high territory is the performance of the bank stocks. What do you think of bank stock valuations right now, PE multiples?
Yeah, right now, if we were in a normal environment, we'd be quite comfortable with the banks at this level. However, given the uncertainty that we have in terms of the economic outlook, it's not a guarantee that the bank's earnings are going to resume the trajectory that we thought they were going to be in 2025. Not to say that they can't achieve that level, but right now, we're neutral to cautious on the banks. And I think that's reflected on the fact that we only have 2 buys out of the group. But realistically, what we're likely to see moving forward is, and what we've seen to date, is just a stronger confidence that we're not necessarily heading into a recession, and that's been a bit of a relief rally for the banks, and I would argue for the broader market, but I'm far from a strategist. But moving forward, it's going to have to be the management team's basically putting a lot of confidence and conviction in the fact that they're not expecting to see significant deterioration in credit quality, as well as the fact that we think the bolstering the provisions is going to be beneficial for earnings outlook in 2026, meaning that either those provisions will flow back into earnings or they've already provided for credit losses in 2026, which should actually help boost earnings. And investors are looking further afield as opposed to just this quarter or the third quarter.
You've got buy ratings on Toronto Dominion Bank and Royal Bank of Canada. Otherwise, you have hold ratings on the other four of the big six. What is it about TD and Royal that leads you to rate them buy?
It's basically sticking with quality, sticking with diversification, and weathering the storm. Royal arguably has the most diverse business model and operations spanning both Canada and the U.S. TD, well, their U.S. operations have been a bit of a black eye. We actually do think that they remain undervalued at this stage in the game. And if TD can actually show some resilience in growth in their lending balance, as well as managing the incremental costs they have with the remediation process on the anti-money laundering issues, I think that will actually shift more confidence in terms of their outlook. And we think that on a relative basis, TD is the undervalued bank out of the group. And we think it's a very good bet in terms of uncertainty.
John, thanks a great deal for sharing a bit of time with us today and your insight. John Aiken, Director of Research for Canada and Senior Analyst at Jefferies. Coming